Hello, and thanks for joining us today. I'm super excited that you could be here because today we're talking about how you can actually bank on yourself. We're talking about not just creating wealth, but really protecting the wealth that you create and the best way to do so. And with us today to have that discussion is Mark Willis. Now, he's a certified financial planner, a three-time #1 best-selling author, the owner of Lake Growth Financial Services, a financial services firm in Chicago, and co-host of the Not Your Average Financial podcast. Now, over the years, he has helped hundreds of his clients take back control of their financial future and build their business with proven tax efficient financial solutions unknown to most financial gurus. He's become known as Not Your Average Financial Planner. Hey, Mark, thanks for joining us today.
Ty, glad to be back on, man. Thank you.
Yeah, I'm excited, man. This is the second time back. I don't invite a lot of people back, but you are so brilliant that I'm like, I got to catch up with this guy and see how he's doing. So how have you been doing?
I must bake some good cookies or something because you brought me back to the kitchen. So let's do some more here together. I'm looking forward to it.
Yeah,
life is good. We got supply chain shocks. We got rampant inflation, market turbulence. It's a good time to be a financial planner, let me tell you. But that's, I guess, why I'm glad to be not your average financial planner, because so far, and like every year, I'm only giving good news to all of our clients who are hitting all-time record highs right now.
That's awesome. So what is some of the good news that you're dishing out to clients?
Well, every time I sit down to chat with our clients over Zoom or over the phone, we're talking about their account statements, and every single one of them have an guaranteed increase in their net worth with the accounts we've set up for them. I can't control their crypto account. I can't control their real estate holdings. I can't control their stock portfolio, but the accounts that I set up with them are specifically designed to grow on a guaranteed basis every single year. And that sounds like a balm. That sounds like a salve. That sounds like sanity in the world that's gone insane, Ty. So that's been a lot of fun for me and a privilege to get to serve our clients in that way.
So what kind of accounts are you setting up for them that give them that kind of security?
Yeah, well, on a first level, I always sit down and listen first. I don't just jump to judgment, and I'm not a good fit for everybody. If they need 100% rate of return every year, I'm not going to be the guy to give them that. I don't know anybody who would, by the way, every year. Maybe one year, that's fine. But after I've listened carefully, we'll sit down and do a high-level financial flyover of their situation, get to know them from a true one-on-one basis. And if it looks like I can be of help, one of the strategies that's a good fit for some of our clients is something known as bank on yourself. And as a certified financial planner, I just can't look away from it. It's a compelling strategy that I think more people should at least know about, even if they decide it's not a good fit for them. For example, of all things, Ty, it's a dividend-paying whole life insurance contract that is specifically designed differently than what you've heard Dave Ramsey or similar, radio gurus talk about on their shows. It's mainly designed for cash accumulation. While there is a death benefit, which is nice for families and legacy, the focus is on the living benefit, what you can pack away and use as a financial tool during your lifetime. I always say it's way more fun to spend money while I'm alive than when I'm not alive. So by building the policy for cash value rather than commissions, there is a big bucket of money that grows on a predictable and even guaranteed basis called your cash value. On top of that, they'll throw dividends if the insurance company is profitable. And that allows the clients, when they open up their account statements, to only have good news. They only have happy surprises, not ugly surprises, which is what we're seeing as the market is off their highs, 20 some odd percent, depending on what index you're following. Interest rates on mortgages have doubled. So there's just very few places to hide in this great big world, financially speaking. But whole life insurance not only has survived the pandemic, which if you think about it, when would there have been a major life insurance crisis? Probably during a pandemic. And yet the companies that I would prefer to work with and select for my clients and myself too, it was business as usual these last 3 years. They didn't skip a beat. Their dividends kept rolling. In fact, some of them have even raised their dividends in the midst of the humanitarian, the world crisis that we all went through. And that just makes me sort of say, wow, nothing's ultimately guaranteed on this side of heaven. As you know, it's all firewood at the end of the day. But that at least as far as a financial basis goes, this is about as sure as you can get.
What do you think that whole life? A lot of people think about whole life or life insurance for death benefits. So, what is it about this kind of strategy that makes it so phenomenal at creating protecting wealth?
Well, the interesting piece here is it's all about the contract. And you think about real estate and you think, well, why is real estate a great way to build wealth? And I believe it is, by the way. It's been that way since the pyramids. All right. Now, what is it about real estate that makes it yours? Is it the fact that you can feel the bricks and drywall and 2x4s? No, technically, no. It's because there's a contract backing your ownership in that real estate deal. The contract is where the wealth is. If you don't have a contract with your name on it saying you own that house, all you got is squatter's rights. And whoever has the bigger shotgun will own that house, if you know what I mean. So the same is true with insurance contracts. All right. So how do insurance contracts work? This is something I was not taught in school. I wasn't even taught it really as I was getting my certified financial planner designation. The insurance contract works like this. You are buying a life insurance death benefit, a big pile of money for your family someday, hopefully a long time from now. Along the way, there's this thing called a cash value that begins to build up. As long as you didn't buy term insurance. Now, there's nothing wrong with term insurance, but there's no equity cash value with term insurance. When you have a whole life insurance contract, it's there for your whole life. I guess that's the worst and the best marketing idea the insurance company's ever had. So the death benefit is a sure thing, and that's an asset to your family. You're definitely going to graduate on it someday, but the insurance company sees it not as an asset, but as a liability to them. If it's $1 million death benefit, that's going to come to your family someday, and that's an asset to you guys, but it's a liability to the insurance company. So what do? They give you a guaranteed increase of your cash surrender value. So you'll be tempted to surrender that policy this year, next year, the next year. And so every year I live, I'm a year older, I'm 1 year closer to that, final moment, right? So they're willing to pay me a little more to go away every single year. It's just actuarial math. 100 out of 100 people will die by age, let's call it 121 years old. So they know if I'm alive next year, I am a little closer to that ultimate day, and they're going to give me a guaranteed increase of my walkaway money to go away. That's the contract. All right. So that's why it's such a pure and I think marketless way to build real wealth, because they know there's a liability coming. It's like a freight train coming at this insurance company, and they're going to give us a walkaway cash on an increasing basis every year. Does that answer your question?
More than answers my question. Makes perfect sense. So how can we use that to our advantage then to be able to build, protect wealth?
Oh, yeah. Well, if we've got an increasing asset that we can count on, well, we can start to call that a financial plan, right? I mean, how can you really call it a plan if you have no clue what your 401k is going to be worth when it's time to retire? How can you possibly have a financial plan if you have no clue what interest rates are going to be or the tax rates are going to be in the future? Whole life insurance grows on a guaranteed, predictable basis every year. We've talked about that. It also is liquid and accessible money. We'll get back to that in a minute. But we can get access to that money if we've designed it correctly, Ty, with no tax due. It's a tax-free bucket of money. If we've designed it correctly under the tax law, we can get the money out totally tax-free. Third, it is life insurance. So we've just now created an estate for our family without having to have a big fancy trust or family foundation. And then fourth, we can borrow against it. So we can use it like a bank to borrow and bank on ourselves. So the big pile of money, it's just like a house, right? You can get a home equity line of credit on your house, and your house continues to grow even if you don't have a HELOC, right? Your house doesn't care if you have a mortgage on your house. If your house is worth $500,000 or $1 million or whatever, and the house has a mortgage against it, does the house only grow on your equity? No, of course not. It grows. Zillow doesn't care if you have a HELOC on your house or a mortgage on your house. Zillow just tells you what your house is worth. So if your house grows 4%, 5% this year, whatever, 10%, whatever, your HELOC, let's say you borrow against that house, you've now got your money doing two things at once. It's growing in the house, but it's also liquid in your hands. And maybe you use that to buy a car or invest in your business or buy a rental property or whatnot. Now, that's similar to these policies, Ty, because when you borrow against these policies, they'll continue to grow and compound as if you had not borrowed the money out. But unlike a house, houses are not guaranteed to go up every year, right? We see reference 2008, just for example. And a HELOC can be taken away from us. They can freeze it. They can call it. They can limit or lower what you can use on your HELOC. They can raise the interest rates. But with a bank on yourself designed whole life policy, there is a guarantee that you always have the right to borrow at about 90%, 85 to 90% of your cash value at any time. And the insurance company cannot deny you that money. It's yours. So this, to answer your question, is a great way to build and protect your wealth, because not only are you building that capital reserve, that guaranteed bucket of money in the policy, but now you can collateralize it. You can now leverage against it. You can borrow against your life insurance cash value. Let's say you got $100,000 of cash value and you borrow 80 grand to go invest in a rental property or invest in your business. Let's say you bought a rental property. So you borrow 80,000, you had 100 in there, you borrow out 80,000, you get your rental property. Now your rental is cash flowing and it's appreciating in the neighborhood. And your policy continues to compound and grow as if you never touched a dime of the money on the entire 100,000 bucks. We just increased our yield without any additional market risk. That's a pretty sweet deal by any measure.
So in that scenario, do we pay the money back eventually?
I'd like you to. I mean, I think most banks would want you to pay a loan to the, you don't want to steal from your own bank. So it's a good idea to repay. Why would you want to repay? Well, so you can borrow it again for the next rental property, right? There is an interest that's charged on loans when you borrow from these policies. And if you never pay it off, there is a slight chance that you might lapse the policy, which is basically the loan is netted out, so you don't have to pay it back, and the death benefit goes away. You lose the coverage. And there might be tax consequences if there were gains. I've never had anybody have that happen to them in over 11 years of doing this now, with over 1,200 policies in force that we've worked with clients all across this country. But it's technically possible. So what do? You just manage that loan like you would anything else. But will the insurance company force you to repay that loan? No, they won't. Is there any kind of required repayment plan? No. You can set up your own schedule at your own pace. And even if it took you, let's say it took you 5-6 years to even put anything on that loan. I have a lot of folks that will borrow from their policy to invest in a real estate syndication deal, and they'll put the money into the syndication deal. And then 5 years go by before there's a cash out event, like they sell the property or they do a refi or something, and they don't pay the loan off until 5 years later. I have other families who borrow from the policy to send their kiddo to college, and then they wait for the kiddo to graduate and then get a full-time job before the loan gets repaid. That might be 6 years before they start repaying on that loan. And the loan works just fine. The policy continues to grow during the 6 years and beyond while they were waiting to pay off the loan.
So in that scenario, the play is that you're borrowing money at 5, just making up numbers. So you're borrowing money for the whole life policy at 5%, let's say, and then you're going into real estate syndication, some other investment that pays you 8%. So that's kind of the idea, is that you're making considerably more on what you're reinvesting the money into than the money's costing you to borrow.
That's right. And I would even bend on those numbers anecdotally from all the policies that I have seen. If you took a loan and then paid it back, let's say over a 4 or 5 year period, your annual percentage rate would be closer to about 2%, given the way I've seen the loans work on the policies and companies I work with, around 2%, 1.9, 2.2%, somewhere in that ballpark. Meanwhile, your policy is compounding and growing on the full account balance. Okay, so the spread there is much better than just 1 or 2%, because you're compounding on everything in your account, the full enchilada, and you're only paying interest on whatever your remaining loan balance is on a simple interest basis. Simple interest is the way that they calculate the interest all year long. So you've got positive arbitrage in your policy, and you've got, as you said, your 8% or whatever on the real estate deal. So it's even better than what you just described, but it's in the you had it correct. I mean, you have a great understanding of this, Ty.
Okay, so let's say Well, first of all, is inflation is what the Fed's doing with rates affect that? Is it based on the prime rate? I mean, if interest rates are going up, we all know that. So does that affect the interest rate on this? Are those two tied together?
Well, that's a great and timely question because you're right. Interest rates have been um, dramatically increasing since I was last on your awesome show. And the truth is, I'm cheering on these higher interest rates. I don't like the higher price at the gas tank, and I don't like the higher prices at the grocery store. Nobody would. However, I love the fact that as an owner of this insurance company, since it's a mutually owned life insurance company, I and all the other policy owners are owners of the company. There's nobody else getting rich off of our backs here. We are the owners of this company. And anybody who has a bank on your self designed policy would be a co owner in one of these insurance companies I'd recommend. But as interest rates rise, guess what? Dividends in our whole life policies will begin to rise in the years to come, which will give us a boost, keeping up with inflation and raising our cash values even greater than what was guaranteed to us. So the party's going to be at my house, man. If this inflation continues, I don't want it to for all the reasons that we hear about in the news, but at least as far as my policy is concerned, well, boy, I'm actually kind of cheering this on. I want at least I don't want hyperinflation, but I love having these normalized interest rates because it just bumps up our interest rate. You go back to 1980, 1981, 1982, look at the dividends of whole life insurance. They were 12, 13, 14%, et cetera, during the same period of time when mortgages were about the same. And that is, if that's any indication of what's to come, boy, I'm glad that a large portion of our clients' wealth are tied up in these policies. Now, I'll quickly add that it doesn't mean that everyone should just cash out everything they own and put it into whole life insurance. Not at all. No, you've got to be able to use this tool in conjunction with the rest of your portfolio. And in fact, I kind of see it like that. It's sort of like the central hub of your financial life, but it shouldn't be the only thing. So go ahead and use this for your other major investments, your projects, your kids' college, your real estate, your business. If you've got an ongoing annual expense in your business, like an inventory purchase or whatever, you might consider using this. But it's not to be in exclusion of your investments or other projects as well.
So do you help your clients then know what to invest in if they're borrowing against the whole life policy?
You know, I will give them guidance and coaching and feedback on their entire financial life. As a certified financial planner, we look at their overall situation, their tax strategy, their estate plan, their investments portfolio, their insurance, of course, not just the life insurance, but all their insurance, their auto, that sort of thing, everything from that soup to nuts. And then I let them make their choice. They've got the same weight of a brain that I do. And I don't want to be somebody's investment guru. I don't need to be somebody's, answer man. It's your money. Nobody should care more about your money than you do. I'll give you guidance. I'll give you points of direction and ideas and coaching and feedback. But and we've got some very sophisticated software that helps folks understand how well they're doing in terms of their readiness for their big goal, whether it's kids' college or retirement or whatever. But at the end of the day, they've got to make that choice. What kind of risk tolerance do they have? And are they ready to pull that trigger?
When you're working with clients, what do you see the biggest mistakes they make? Probably before they get to you, because you help them, not make those mistakes. But what are some of the biggest mistakes people are making now or that you've seen recently when it comes to them trying to accumulate wealth?
One of the things is they've been saying lately is they want to buy the dip. And what if it keeps dipping is my response. There's no telling whether we're catching the bottom or if we're catching a falling knife. And you really don't know. And that's the problem. That's the mistake. We feel like we've been here before. We've seen flash crashes like in March of 2020. But the honest truth is nobody knows what the fall or the winter or the spring is going to look like. And when you're hearing this, even if it's years later, we just don't know what the market's going to be. And that's the real problem to me. No one has that crystal ball. And why do we tie our entire financial life around things we have no clue about? Another case in point, not just the market, but taxes. Taxes are something that Congress has yet to decide what they're going to be. not just next year, but the year after that, the year after that. And if you're going to live for the next 20, 30, 50 years, and you have money in taxable accounts, whether it's a real estate account or a brokerage account or a 401k, heaven forbid, a 401k, the Congress gets to vote on how much of that they own every single year for the rest of your life. And if you give Congress every year of the rest of your life to decide how much of that 401k or brokerage account they own, they're probably going to take some, right? And that's a big surprise to a lot of people, that not all of their 401k balance is theirs. And many people, even though they believe taxes will go up, Ty, you tell me if you've heard of this too, but many people will acknowledge that they believe taxes will go up. And yet many of us are all putting money into tax deferred 401ks and IRAs and brokerage accounts and real estate even. I mean, we were even talking about seeing the end of the 1031 exchange earlier this year. So is it possible that over the rest of our lifetime, some of those quote unquote loopholes will be sucked dry as the government looks for more and more places to, bleed us dry? So when we act against our beliefs, I believe it creates stress in our bodies, in our minds. I mean, I want a 6-pack of abs, Ty, but I still love chocolate ice cream. And so I act against my beliefs all the time. So that is one of the big quote mistakes. It's just the human nature that we don't always know why we're doing what we're doing, except that we've been told to do it, whether it's market madness or tax confusion. We all act against our beliefs. What would you say? Would you add anything to that? You work with folks all over the country as well, I know. So what do you notice?
No, I think you're spot on. I absolutely think you're spot on. I think that makes a lot of sense. I think whole life makes the most sense for the reasons that you're describing. And I kind of see it as double dipping. I don't understand it. It's like in my world, we deal with securities financing, and it's the same thing. I mean, you could borrow up to 90% of the value of stocks and bonds with a credit line of 5%. Like that seems absurd to me. You're making money in the market, and then you take the money you're already making money on, and then you leverage it another way to make even more money. So it's astonishing to me that more people don't see what you're talking about and take advantage of those opportunities. So like I said, it's like double dipping. It's like literally taking the same dollar and deploying it 2 different ways to get you a greater rate of return. And since all the audience are all entrepreneurs, it should make sense to them because they have a way to be able to invest and save money. And then they can leverage against that to be able to do the things like grow businesses and the things that they're so smart at. And on the other side, I see my mom and dad, right? And, they're retired. And I hear those conversations about the market being down and the fear that they have because everything they've saved for their whole life is like, now it's in jeopardy. Like they're at the end and it's like this tug of war. They never know how it's going to end up and the stress that causes them. And that stuff shouldn't happen. You shouldn't work your whole life and save money. And then the government's coming in and every person that comes in, the president does something different. They pull back what somebody else did. So I'm 100% spot on everything you say.
Love it. Well, there's 3 phases to most people's financial life, and most of us only know about 2 of them. And the third one is right sandwiched in the middle. And because we don't know or act on number 2, it can be devastating to us. The 3 stages, and I'll be brief about this. Number 1, accumulation phase. Most of us are pretty familiar with accumulating. We build up, pack away, squirrel away, add our rental properties, add our 401k assets, pack away money in our brokerage account, whatever, right? Accumulate. And then we skip phase 2, which is preservation. And then we go right to stage 3, which is distribute. So we go up the mountain and then we come down the mountain, but we forget to lock in. And when you climb up Mount Retirement and you plant your flag at the top, and then there's a mega earthquake, like the market might drop or, taxes might change or whatever, you can fall down that mountain. I'll tell you a quick story. I was going up Mount Fuji, and that was hard. But coming down the mountain was like, I felt like I was going to die at least 3 or 4 times. I thought I tripped. I was like, I'm going over the edge. It was not a good, I was scared. I was really scared for my life. And that's true. When you're coming down Mount Retirement, yeah, there's no plan. You don't know how long you're going to live. You don't know the order of the returns of the stock market. You don't know the order and the pace by which taxes will be raised on you. You don't know what inflation is going to be like. You don't know if you're going to have a long-term care event. And coming down that mountain, yeah, it could be devastating. So locking in, preserving what you've accumulated is the central step of the financial life that most people just jump right over. And that's to their detriment, unfortunately.
Yeah, and it's really preservation about their money, what they pass their kids, and those type of things. Because it really is astonishing to me sometimes of what our government feels they're entitled to. Like it just seems crazy to me. Like
Right.
I mean, before the tax rates are cut, like 40% of whatever I'm making a profit, the business they take. Well, you're not there to cover my losses. Like it
Right.
doesn't even seem fair. And the same thing with the death benefits and all the things where it's back and forth between administrations of how much money that's our money we get to keep when we
Yeah.
die versus like give it to the people that we made the money to be able to support. So
Yeah. I'm with
like
you.
you said, everybody has their hand in the cookie jar, especially the government, where they just want to take what we've worked so hard to be able to earn.
We all think it's normal that half of our money almost to somebody other than the one that was there to create. Back in the beginning of this republic, beginning of this country, tax rates were, what caused much of the foment of revolution, right? The Tea Party and whatever, the original Tea Party, I mean, the ones that were in Boston dumping tea into the harbor. And so they say, economists looking back on historians and economists say the rate of taxation was about 1% to 5% of somebody's income. And that caused a world, well, not a world war, but, a mega war between the greatest empire of the current day, the Great Britain, and this feeble little colony, series of colonies here in the United States. And now we're up, and if you're in California, you might be over 50% money going to state, federal, local governments, and more's on the chopping block. So you're right, man. Why is that normal? And more importantly, what can I do today to protect myself from that future where tax rates might even double from where they are right now?
Yeah, there's days I wish Great Britain would take us back. Like we've had
That's
stuff.
right.
We'll take the 5%. We messed
Yeah.
up. Yeah.
Yeah,
But it's so
even the
true. I
feudal
had a guy on the
system was
podcast the other day
25.
that he sets up citizenship, secondary citizenships for people. And I said to him, like, why do people really want to have these multiple citizenships? And he started to get into taxation. It was really shocking. I didn't realize how high the United States was in taxes compared to so many other places in the world, and how many laws we have that compared to other places in the world. And those were just really shocking to me. It's just not normal,
Yeah.
but yet we become so accustomed to it that we, like you said, we don't take the right steps for preservation to protect ourselves to keep the money that we make.
Hey, we've got a income tax that's been around a little over 110 years, almost 110 years. 1913, I guess, if I'm doing my mental math right, was when it was started. And guess what? Life insurance existed before the income tax system, and it existed for over a century before the income tax was even born. And life insurance was grandfathered into the tax code. And for these last 100 years, now for over 200 years, life insurance has enjoyed a very tax favored treatment with the IRS. And every time they change the laws, this is really cool and really important. The only time they ever changed the law on life insurance was back in the Reagan administration. So we're not just beating up on blue states or red states. There's all kinds of administrations that'll raise your taxes if you're not careful. But in the 80s, life insurance had a tax change, but and lost some of the key features that had been enjoyed before. Now, all the ones that I have that I personally own still have the same tax treatment that my great grandparents would have had on their life insurance policies had they had them, 80, 100 years ago. But one type of life insurance lost some key tax advantages in the 80s. But guess what? The people who owned that particular kind of life insurance, let's say they bought it in the 70s, and now the 80s, the law changed. Those 1970s policies were grandfathered into the new tax law. In other words, because they preserved their wealth before the law changed, it was grandfathered in. And they got to keep the juicy, sweet, purely tax-free nature of those single premium type policy, that particular kind of life insurance. Now, again, most of the policies we recommend today are truly and completely able to be accessed, both principal and gains, 100% tax-free. And if history is any precedent for the future, if tax laws change on life insurance again, well, you might be grandfathered in if you had a policy set up before the law changed. So yeah, preservation, thinking in advance, and building contracts around your wealth. If we lose the contract, Ty, if this country loses the contract, the basis of, private agreements between private citizens, if we lose that, we've essentially lost civilization, in my opinion. If we don't have the contract, what do we have, right? So build your wealth around contracts, paper assets, market assets. Those are up and down. Paper up, paper down. Wealthy today, feel terrible tomorrow, right? But if you can build your contractual wealth on the basis of contracts, yeah, you've got yourself something that you can count on.
Mark, great advice today. Where I could sit here and talk to you for hours because you're such a smart guy, and everything you say is so spot on. I just absolutely love it. I appreciate you sharing. Where can everybody go watching and listening to be able to learn more?
Well, thanks. Yeah, if you'd like to build your wealth with contracts toward a future that you can know and control, I'd love to chat. We can help. Go to kickstartwithmark.com. That's kickstartwithmark.com. That's Mark with a K. And we can have a quick 15-minute chat. You can get to know me. You can find our podcast there. It's all at kickstartwithmark.com.
Perfect. Thanks again, Mark. Appreciate your time.
Thank you.
All right. So listen, if you're listening and watching this, this is so important. The problem we make as entrepreneurs is we're so busy building businesses that make money that we do a really crappy job of trying to protect the money that we're making. And that's the money that we work hard to be able to make, not just for us, but for our family, for our kids, for the people that will rely on us in the future. And that's really one of the things you should be focused on most, but you don't have time to. And that's exactly what people like Mark and what his firm does for you. So what you should do is make sure you go to kickstartwithmark.com to talk to Mark more. Kickstartwithmark.com. We just scratched the surface of topics here, but there's a much deeper dive you want to take because it's subjective. Everything we're talking about here is on the surface, but you need to talk about what's real for you in your situation. And that's a conversation Mark will absolutely have with you. As a matter of fact, I'm going to put links to Mark's website, to his podcast that you need to listen to. It's phenomenal, as well as his other social media links on the show resources page as well. But the action you should take right now is go to kickstartwithmark.com. The conversation is 100% free. It doesn't cost you anything to have a conversation. And you might have a lot of revelations where all of a sudden now you're over here building an asset that's growing in value and putting your money somewhere where it's predictably safe that can continue to do that with you and give you the financial freedom that you've always wanted. So make sure you go to kickstartwithmark.com. Thanks for tuning in.